to get some common sense on inflation and rising gas prices from Craig Bolanos, the CEO and founder of Wealth Management Group. Good to see you there, Craig. And the inflation gauge is up 7.9% in the latest read. Do you think it's likely to go up from here, or that the Fed will make a difference sooner rather than later with the rate hikes?
Well, Angela, certainly the most recent inflation numbers are big. I mean, the 7.9% print, that's the highest print we've had since 1982, and it's a clear reflection of the ongoing supply chain challenges in the face of robust consumer and business demand with an elevated backdrop of all things that is Ukraine. But I do want to point out that we are going to be coming into a season of year-over-year comparisons, aka March through June of 2021 compared to March to June of 2022. Inflation had already been moving in the second quarter of last year, so some of the data might soften a little bit less oil going forward. Now, I have to think, as do a lot, that as supply and demand are brought back into balance, some of these price pressures, they're going to subside or subdue a bit over the long term, because we still have these forces that are limiting inflation. Globalization, and more importantly, technology, that should ultimately prove stronger than the current inflationary pressures, but for the time being, it's going to cost everybody more in our daily lives.
Craig, you mentioned oil. Do you think that the elevated prices will be enough to drive the U.S. into a recession?
Well, oil is an essential ingredient when it comes to a growing economy, and certainly high oil prices, they work to throttle down economic growth. But right now, I would say it's not about how high oil prices get, but it's really going to be much more about the duration, how long oil prices stay highly inflated. And there's also several things that investors should be looking for outside of oil when it comes to making an assertion as to whether or not we're heading towards a recession in the United States, which right now is a possibility, not a probability. First, recessions are almost always preceded by very high real interest rates and or an inverted yield curve. And currently, we're not accompanied by either of those two conditions. Next, when recessions are coming, we typically see swaps, credit spreads, the 2-year, blow out. And that hasn't happened either in the US, although we've seen some technical damage over in European spreads. So therefore, what I think about right now is we still have liquidity. I would argue it's abundant liquidity at that. And it's liquidity that proves to be one of the best ways for a developed economy to hold or maybe even starve off a recession, because liquidity allows for the transfer of risk. But it's when liquidity dries up that panic could ensue, in the same way someone maybe yells fire in a crowded theater. And that's not just visible today. So the bottom line is, stay committed to your investment policy statement that should have been driven from your retirement plan. Remain daily vigilant when it comes to your asset allocation, your diversification, security selection, and rebalancing protocols, because this too will probably pass. I'm Craig Bolanos, the CEO and founder of Wealth Management Group. If you want to connect and learn more, go out to our website, investwithwmg.com.
Go to businessfirstam.com for where to see our show on TV.